Good evening. Please come to this wonderful standard IFRS 9 again. So the next paragraph is embedded derivative. So what is an embedded derivative? Understand, a derivative which is added to another instrument. A derivative which is added in another instrument is called embedded derivative. Embedded means to add. Okay. So basically it's a hybrid instrument which contains one host contract and one embedded derivative. You have studied compound instrument some days back. Compound instrument was from the point of view of issuing company. From the point of view of issuing company. But when you are an investor, a similar instrument becomes for you an embedded derivative. Okay. So in simple words, it is a derivative instrument embedded in another contract which is known as host contract. So two things are merged into one. One contract, and a contract contains a derivative also. Say for example, bank has given loan. Loan has a condition. In case if the company does not pay, the loan will be converted into equity. Or there can be just a condition that after 5 years the loan will be converted into equity, or the bank has an option to convert the loan into equity. So loan is the contract, the host contract, but that loan also contains an agreement to convert into equity shares. That means there is a derivative contract also embedded in that. An option to convert loan into equity has the feature of a derivative. Okay. So therefore, a derivative instrument is embedded in another contract. Such instruments are called hybrid instrument, and the derivative is known as embedded derivative. Now what we are trying to do, can you guess? This is the hybrid instrument. It contains host instrument, it contains derivative also. So the standard says remove this derivative. Subject to some conditions we will see. Remove this derivative because accounting for derivative is separate. Derivative is accounted using which category? FVTPL category. Whereas this host instrument may be something else. The host instrument may be an instrument which is FVT OCI category. The host instrument can be an instrument which is measured at amortized cost category, or it can be a non-financial asset also, or the host contract can be a non-financial asset also. So if you merge the two and you don't separate them, then the problem is that suppose the host contract is measured at FVT OCI, even the derivative will get accounted as FVT OCI. If the host instrument is measured at amortized cost, even the value related to derivative will also treated like amortized cost. Substance over form again. In form it is one instrument, but in substance there are two, and these two may be subject to two different accounting models. So the standard says separate them and do the accounting of the host instrument depending upon its classification and its type of asset, and account for derivative as FVTPL. So you should not be able to avoid the FVTPL accounting for derivative by merging it with another host contract. So the reason the standard gives you, an entity should not be able to avoid recognition and measurement merely by embedding a derivative in a non-derivative financial instrument or another contract. So smart companies, what they can do, they can have a contract which has similar feature of derivative, which is derivative, but they don't want to follow FVTPL accounting for derivative. They can merge it with another instrument and can avoid FVTPL accounting. Standard says no, you can't do that. Remove derivative. Account derivative like a derivative and account the remaining instrument depending upon their classification or their category of asset. So see, this diagram is there in your book also, but in the form of a statement. Suppose there is a debenture or a bond. It is a primary instrument written there. So this we will call host contract. And suppose it contains an option to buy or sell share. So it can be debenture, bond, loan, which contains an option to buy or sell shares. This option to buy or sell share is called derivative. Merge the two, it becomes a embedded derivative contract. So primary plus derivative, we get an embedded derivative contract. A convertible debt instrument is an example of embedded derivative. So derivative is included in a host contract. Derivative is included, embedded in a host contract. So what can be the host contract? The host contract can be a debt instrument, which is common like convertible debenture, convertible bond, loan convertible into equity. But the host contract can be other contracts also. Like host contract can be equity instrument. Host contract can be sale contract, insurance contract, purchase contract, or a lease contract, or a service contract. And the derivative which can be embedded in this host contract can be a foreign exchange forward contract, an inflation factor, or a conversion option. Okay. So now we'll see the accounting. What we'll do, very simple. Accounting of embedded derivative. First you see what is the hybrid contract. Hybrid contract can be a contract where financial asset is the host contract. A convertible bond is an example of this category because the bond itself is a financial asset and it contains a derivative, an option. Okay. Or it can be any other hybrid contract. It can be any other hybrid contract where the host contract is not a financial asset, like a purchase contract, sale contract, which may have some option also embedded in that. So accounting treatment now. Hybrid contract with financial asset as a host contract. Convertible bond. It's a hybrid contract and the bond is a financial asset. So the host is a financial asset. The host which is embedding the derivative is a financial asset. So if a host contract, if the hybrid contract contains a host that is an asset within the scope of this standard. Which asset is within the scope of this standard? Financial asset. Only financial asset and financial liabilities are under the scope of this standard. Is it right? An entity shall apply the requirement of the standard to the entire hybrid contract. So what entity will do? Suppose this is a bond. It contains an embedded derivative also. So embedded derivative will be separated and it will be accounted as FVTPL. And this bond will be accounted using, depending upon what is the classification, FVT, OCI or amortized cost. So this standard is applicable to this part also, depending upon the classification, and this standard is applicable to derivative also. So this standard is applied to entire hybrid contract, but yes, we have to separate them. And if it is other hybrid contract, suppose it is a sale contract, purchase contract, and then it contains some derivative, the standard will apply only to this part. The standard will apply only to derivative because that comes in the scope of this standard, and this contract will be accounted as per respective standard depending upon what is that. If it's a lease contract, for example, then the standard on lease may apply for the remaining part. Okay, so hybrid contract, if the hybrid contract contains a host that is not an asset means as per this standard, not a financial asset, embedded derivative will be separated from the host and accounted for as a derivative. So this portion will be separated and accounted like a derivative if and only if. So what are the conditions when you have to separate them? What is the situation when you will separate them? So there are three conditions. If all three conditions are satisfied, then you will separate the derivative from the host contract. If all three conditions are not satisfied, then there is no need to separate. So which are these three conditions? So you'll see in your notes there will be three conditions. One, the economic characteristics and risk of the embedded derivative is not closely related to the economic characteristic and risk of the host. Economic characteristics of the embedded derivative and the economic characteristics of the host instrument are not closely related. Now what do you mean by not closely related? That means the factors which affect the risk and return of derivative are different from the factors which affect the risk and return of the host contract. So if you want to write the explanation, the factors affecting risk and return of derivative are different from factors affecting risk and return of host contract. Is it right? So sometimes the derivative may be like this, that the rate of interest will vary with the change in the value of gold price. Rate of interest will vary with the change in gold price. And suppose the underlying is a debt instrument. Now debt instrument value changes due to change in market rate of interest. Price of the gold may vary due to other factors, not because of the change in market rate of interest. It depends on demand and supply of gold and other factors. So in that case, they are not closely related. But suppose there is a debt instrument and there is an interest rate swap which is embedded in that. Now in that case, the value of debt instrument and the value of interest rate swap both are affected by interest rate. Then they are said to be closely related. And if they are closely related, no need to separate. Don't separate close relatives. Okay. Don't separate close relative. If they are very close, that means their movements are in the same direction. A separate instrument, the second condition is that a separate instrument with the same terms as embedded derivative would meet the definition of a derivative. Means whatever are the features of this embedded derivative, there can be a separate instrument with the same feature and that will be known as derivative. That means the feature should reflect the derivative features. Whatever you have embedded, it should reflect derivative feature and it should be capable of being called a derivative on a standalone basis. So the simplified version of second condition is that it should be known as derivative on a standalone basis. If I remove this feature, it should be a derivative on its own. So it should be capable of being known as a derivative on standalone basis. And the third is the easier one. The hybrid contract is not measured at fair value, with changes in fair value recognized in P&L account. So hybrid instruments should be such that which should not be measured at fair value through profit and loss account. This is easy. The third one, if the whole instrument is measured at fair value through P&L account, then the change in fair value of the host contract will also go in P&L account. Change in the fair value of derivative will also go to P&L account. When both have to go to P&L account only, why to separate? So that is why in my example, if you would have noted, I have written FVT OCI, I had written amortized cost, but I did not write FVTPL. Because if it is an FVTPL instrument, if the hybrid contract is such that its change in fair value is recognized in P&L account, then there is no need to separate, because in any case, the change in derivative also goes to P&L account only. This can be explained with the help of a small diagram only. Same 3 points, but to keep the students awake, they are made to draw the diagram in the class. Same 3 points. They can ask you a simple theory question also. Write a note on embedded derivative and the condition to separate the embedded derivative from the host contract. Okay. So this is like a decision tree. First is the contract carried at FVTPL? Just write down, is the contract carried at FVTPL? Or is the host contract carried at FVTPL? If the answer is yes, the host contract is carried at FVTPL, then do not split out the embedded derivative. No need to split the embedded derivative. No need to separate. But if your answer is no, the host contract is not an FVTPL instrument, then the second question you have to ask, would it be a derivative if it was freestanding? Freestanding means derivative on its own. Is it right? Would it be a derivative on standalone basis? Will whatever embedded features are there, will it be called as a derivative on a standalone basis? If the answer is no, if I remove it, then it is not a derivative. Then do not split out the embedded derivative. But if the answer is yes, then apply the third test. Is it closely related to host contract? If the answer is yes, it is closely related. Again, no need to separate. But if it is not closely related to host contract, then split and separately account. Then split and separately account. First condition, it should not be FVTPL. It should be a derivative on standalone basis, and its economic characteristics are not closely related to the economic characteristics of the host contract. Then you will have to separate them. Okay. Substance over form. The logic is substance over form, because derivatives are accounted using FVTPL category. And if the host contract is not an FVTPL category, then there is a need to separate. Otherwise, companies will do the accounting of derivative also, like either FVT OCI or amortized cost, or like any other instrument. Some simple questions for you. Okay, just to check whether you can identify whether, question is whether you need to split the embedded derivative or not. So apply those 3 tests, which you have read just now, written also just now, and after applying those 3 tests, you have to answer yes or no. Yes means we have to split, no, we will not have to split. question in your book. Entity A is seeking to identify embedded derivative that are required to be separated under IFRS 9. It is considering whether these contracts contain embedded derivative. An investment in a bond whose interest payment are linked to price of the gold. The bond is classified as FVTPL. Now see here, if the host contract is classified as FVTPL, if the answer is yes, do not split. So answer of the first question is do not split the embedded derivative. Do not split the embedded derivative. As the host contract is carried at FVTPL. Second question, an investment in a bond whose interest payments are linked to the price of silver. Whose interest payments are linked to price of silver. So they are not closely related. The bond is classified as FVT OCI. Now again I will go to this diagram. First condition you have satisfied. The host contract is not an FVTPL. Second condition, you assume yes, that whatever features are there will meet the definition of derivative on a standalone basis. Third thing you have to check, is the host contract closely related to derivative? No. The interest payment is linked to the price of silver. The economic feature of bond and the economic feature of interest depend on different set of factors. The value of bond and the amount of interest will be affected by different set of factors, not same set of factors. So therefore this is a case where you need to split, write down, split the derivative, split the embedded derivative, as host contract and derivative are not closely related. As the host contract and derivative are not closely related. Next paragraph. An investment in a convertible debt instrument that is classified as FVT OCI. So first is it should not be FVTPL. That condition we have satisfied. Then there is an option to convert. So there is a derivative and convertible into equity share. And the host contract is a debt instrument. So are they closely related? Option to convert into equity share and the host contract debt instrument, are they closely related? Are the factors affecting price of equity share same as factors affecting the price of bond? No. Is it right? So they are not closely related. The value of the option will change as the value of equity share would change. And the value of equity share would change due to many factors. Donald Trump becomes president again, value of the equity will change, which is not connected to the rate of interest. Okay. So the answer is split. Okay, one more. D, a lease contract that has a rent adjustment clause based on inflation. Lease contract. So this time it is a lease contract, a non-financial asset that has a rent adjustment clause based on inflation. Lease rentals are affected by inflation or not? So are they closely related, lease contract and the rent adjustment clause? They are related. They are closely related because the rentals are determined on the basis of inflation only. And the rent adjustment clause is also affected by inflation only. No? How do you fix the rent of your tenant? Don't you take into account the inflation factor also? And rent adjustment clause is also based on inflation. So here the answer will be do not split, because host contract and derivative feature are closely related. Do not split because host contract and derivative feature are closely related. Now one question which is not printed in your book, we have to write. But first to check if it is printed, then I will not trouble you. No. Write down little fast, no problem. Because we need to solve one accounting problem also. Concept you have learned, but then how do you apply in practice? So dear student, write one question. Indian company, write in notebook, bring a good notebook. Indian company, don't bring just pages. Indian company enters into a contract to purchase. Indian company enters into a contract to purchase steel. Raw material. Steel is a raw material for this company from a local Indian supplier in 6 months in US dollar. So there is a contract to purchase the steel. So purchase contract, but the contract is to purchase in 6 months in US dollar. USD is not the functional currency. USD is not the functional currency, means the main currency. Currency in which you normally operate is called functional currency. Currency in which you normally function. Most of your transactions take place is called functional currency. But it's an Indian company. USD is not the functional currency of either party to the transaction. The steel will be delivered. The steel will be delivered and used over a, the steel will be delivered and used over a reasonable period in the normal course of business. Contract is entered into on 1st January 20x5. Contract is entered into on 1st January 20x5. The contract is over. The contract is over a specified amount of steel. The contract is over a specified amount of steel for USD 1 lakh. The contract is over a specified amount of steel for US dollar 1 lakh. The 6-month forward exchange rate is USD 1 equal to INR 65. 6-month forward rate is USD 1 equal to INR 65. The 3-month forward rate, on 31st March 20x5 which is the Indian company's year end, IC means Indian company, is USD 1 equal to INR 63. and the spot exchange rate on 30th June 2005 when the steel is delivered is USD 1 equal to INR 63.5. How is the accounting to be done? The question looks simple, but if you look at it carefully, this contract has a embedded derivative in it. As the rate of exchange is changing, the value of this contract will also be changing. So what the standard says just now, apply the three conditions. Is the contract measured at FVTPL? No. It's a steel contract to buy the steel. But that embedded feature that the payment will be made in USD has feature similar to a derivative. As the value of the dollar will change, the value of this contract will also change, and this factors affecting the price of the steel and the value of USD are different. So the host contract and the derivative are not so closely related. So in this case, we have to account for some embedded derivative inside this contract. And as the fair value will change, that difference will be recognized in profit and loss account. So for a better understanding, we'll write a note and then pass the journal entry. In the exam, if you don't have time, directly start with journal entry. The entire contract meets the definition of a derivative. The entire contract meets the definition of a derivative. So there is a contract, but it has an embedded derivative inside it. Why it is a derivative, right? It has an underlying that is in bracket the price of steel, no initial payment and is settled in future. Third paragraph. Now you have steel as underlying. Steel does not form part of this standard, but the contract whose value is changing will form part of this standard, and therefore that part will be accounted under this standard IFRS 9. So right, because steel will be physically delivered, it's not a net settled contract. Because steel will be physically delivered and is for use in the normal course of business the contract qualifies for normal purchase requirement scope exception. It means this contract as such is not in the scope of the standard. It's an executory contract. The contract qualifies for normal purchase requirement scope exception. In bracket executory contract. This means that the entire contract is not a derivative recognized on at fair value with changes in fair value with changes in fair value recognized in profit or loss. So this whole contract is not an FVTPL instrument because it is having an underlying steel which will be settled by delivery of steel and making payment for steel. We have learned earlier also, yesterday also in one answer we have written, if the contract will be settled by delivery of a non-financial asset, it's an executory contract. But if the contract has a derivative element in that, derivative will be separated. Derivative will be separated and accounted like a derivative. Because this contract is denominated in dollar, the value is changing as the rate of exchange is changing. Had it been contracted in rupee only, then it was a fixed amount. No derivative. No further accounting. So write down accounting on 1/1/2005. What was the date I had given? 1st January 2005. No entry because the fair value of derivative is nil. On the date of contract, the fair value of derivative is nil. Only note. Now what about the year ending date? Now year ending date, if you see the question 31st March, first I'll go to the question to explain. The 6-month forward contract rate is 65 in the market for US dollar. But when I go to 31st March, I find that the 3-month forward rate for dollar is now 63. Why 3-month rate is given? Because remaining period is only 3 months. Remaining period is only 3 months. If I want to enter into a forward contract now for the remaining maturity, now the dollar is available at 63 rupees. Okay. Earlier it was 65. And I am purchasing the steel. If I am purchaser of a steel which is denominated in US dollar, at the time of purchase the rate was 65. But on the balance sheet date, the rate is 63. Will I be happy or sad? Happy. Exchange rate is going down. Exchange rate is falling. So you will have to pay less. So therefore, the inbuilt derivative in this contract gives you a benefit of 2 rupees per dollar. The value of the contract in your favor moves by 2 rupees. And how many dollar is at stake? 1 lakh. So you will gain 2 lakh. So write down embedded derivative account debit to P&L account 2 lakh. In the exam, if the question is for seller, it is a loss in that case. Reverse the entry. Embedded derivative account debit 2 lakh to P&L account 2 lakh being fair value gain on embedded derivative recognized. Derivative feature will be separated and accounted like a derivative. Now come to the date of execution, 30th June. What is the rate of exchange on 30th June? 63.5. Oh, rate has gone up. Gain or loss? Loss of 50 paise into 1 lakh dollar. Reverse the entry by 50,000 rupees. 30th June 2005, P&L account debit 50,000 to embedded derivative 50,000. So you are recognizing the change in fair value of derivative, which is embedded in this contract. If this contract was denominated in rupee, then there was no problem. Okay, but if it is denominated in US dollar, then as the rate of exchange is changing, the value of your contract is also changing. Now you'll purchase the steel stock. At what rate you will purchase? 63.5. Steel stock account debit to bank account. Steel stock account debit to bank account. 63.5 into $1 lakh, 63 lakh 50,000. 63 lakh 50,000. Being payment made to buy the steel. Now wait. There is one account which you have opened. Embedded derivative account. What will you do with that account? Huh? P&L account, you have already transferred the change. Now this account balance will be adjusted against the value of the stock. This account will be adjusted against the value of the stock. Steel stock account debit 1,50,000. To embedded derivative account 1,50,000. Narration right. Being embedded derivative removed from the balance sheet, removed from SOFP, sorry, statement of financial position, and adjusted in the cost of steel. So what will be your total cost of steel now? Total cost of the steel would be 65 lakh, which is the same as per the rate when you entered into the contract. Okay. What is the purpose of the substance over form? When you entered into this contract, that time the rate of the exchange was how much? 65, which means you had purchased the steel whose value was 65 lakh, but it has an embedded derivative. So by using the embedded derivative, you are trying to shift the profit from one period to another period. So that is why they have said you account for derivative like a derivative, and then the derivative account will be closed by adjusting it against the cost of the steel, because the change in fair value has already been recognized in profit and loss account. So now that derivative account will be adjusted against the carrying amount of that steel stock. So now we'll come to the last part of this chapter, that we will call hedge accounting. Okay, very simple. If the company enters into a forward contract, that is hedge accounting. We'll see that. Okay. If the company enters, that in the problem, company is not entered into any forward contract. That is only for calculating the value of the derivative. We are using the forward rates. If the company enters into a forward contract, then we'll have two contracts. Is it right? And then we will account for derivative separately only. Okay. So come to hedge accounting. Hedging refers to action designed to reduce future uncertainty of cash flow or value of asset or liabilities. A student of people like you who are doing so many courses, advanced courses, know the meaning of hedging better than me. What is hedging? To reduce the risk. Hedging means to reduce the risk. In business, there are several types of risk. For example, if you buy equity share, you invest in equity share, what is the risk? Share price may fall. That's it. As simple as this. You have investment in bond. What is the risk? Interest rate may change. So if interest rate goes up, the value of the bond will fall. If interest rate goes up, the value of the bond will fall. So this is the risk. If you have receivable in foreign currency, what is the risk? You are an exporter. You have to receive $1 lakh after 6 months. What is the risk? Huh? Exchange rate may fall or change. Exchange rate may change and it may cause loss. You have payable in foreign currency. Again, exchange rate may change and it may cause loss to you. You have issued a floating rate bond which pays interest at LIBOR plus 2%. What is the risk? This LIBOR rate will go up, so you have to pay more interest. And if you are an investor in this LIBOR plus 2% bond, so if the LIBOR rate falls, you will have to pay, you will receive less interest. If suppose you use wheat for your production of bread, you are a company selling bread, you use wheat, what is the risk? The price of the wheat can go up. So that is the risk. If you are a airline company, the cost of the fuel will go up, price of fuel will go up. So these are the risks. So that is why they have written to reduce future uncertainty of cash flow or value of asset or value of liabilities. So you can hedge the risk. Name some risk hedging instrument. Name some risk hedging instrument. Forward, future, option, currency swap, interest rate swap, and there are some more advanced products, but we will discuss this much only. What is a forward contract we have discussed? A contract to buy a specified quantity at a specified price on a specified date. Okay. Future is also similar contract, but it is traded on an exchange. Option is a right but not the obligation to buy or sell. Swap means to exchange one stream of cash flows against another stream of cash flows. So swap is used to convert your fixed rate obligation into floating rate obligation into fixed rate obligation. Receivable in dollar can be converted into receivable in rupees. That is currency swap. So currency swap, interest rate swap are used. Businessman uses derivative to a large extent nowadays. So there are separate departments in big companies whose job is to protect the company from different types of risk. Otherwise, you'll work for the entire year and exchange rate changes and you suffer the loss. So you have to plan in advance. One of the instrument used for hedging is forward contract. So what we do, we lock the rate in advance only. Okay. So I have a receivable, $1 lakh, example only. When I say I means is example. After the class, you will ask me, sir, who is your debtor? So $1 lakh I have to receive. Okay. And it is receivable after 6 months. So this is the invoice value. This is the time after which I will receive. But I am worried that dollar rate may fall. Dollar rate today, spot rate, is 69 rupees per dollar. But then there is a risk that this may fall. And if it falls, I will get less rupees. So I go to a bank and I enter into a forward contract. Bank says after 6 months, we will convert your dollar into rupees at 68.50 rupees per dollar. Do you agree? So I'll say, okay, yes, I agree. So I will lock the rate. Now there is an advantage and there is a disadvantage. Advantage is that suppose the rate actually falls down, it becomes 62 rupees. Still I will be able to convert $1 lakh at 68.5. But there is a disadvantage. If the rate goes to 75 rupees per dollar, still I will be able to convert dollar into rupees at 68.50 only. Is it right? But at least you are now sure of receiving 68.50. Otherwise, you have to carry the tension till 6 months every day. So take a forward contract. 68.50 also gives you enough margin of profit. Lock the rate and focus on work. Don't look at the rate now every day. This is how a businessman would think. Okay, I am happy even if I get 68.50, I'll get 68 lakh 50,000 rupees. That is more than my cost of sale, and I am happy with that. But if you don't do anything and if the rate goes down substantially, you will suffer a heavy losses. That is forward contract. Or say for example, you have investment in shares, 1 lakh share. Market price is 100 rupees today. So the value is 1 crore. You want to sell it after 6 months. Convert into rupees, cash, and then you go to Stanford to study the MBA course. Right? After 6 months, the price may fall to 20 rupees per share. Who knows? Value of your investment will become 20 lakh. From Stanford University, you'll end up into Pune University. From a chartered accountant, you'll become a shattered accountant. Okay. So what you should do? There are several ways you can hedge the risk. You can buy a put option. You can buy a put option. Put option gives you right to sell. So you buy a put option at say 102 rupees. Now what will happen after 6 months? Market price is below 100 rupees. You will exercise your put option and sell at 102 rupees. So you're guaranteed 102 rupees. But if the market price is suppose 150 rupees, you will let your put option lapse and sell in the market at 150 rupees. So by buying a put option, you ensured in this example that you will not suffer a loss. Either you will get 102 or more than 102, but not less than 102. So that is also a hedging instrument. Okay. Or suppose you have invested in a fixed rate bond. Fixed rate bond are exposed to market interest rate risk. You have investment in fixed rate bond 200 crore rupees and you want to sell it after a year. You want to sell it after 1 year. But then there is a risk. After 1 year, the interest rate may rise and the value of your bond can fall. So when you'll go to the market to sell this bond, you'll find that it has gone down to 180 crore rupees because market interest rates have gone up after 1 year. So to avoid this risk, what you can do? You can use an instrument called interest rate swap. So the loss in this will be compensated by a profit on this instrument. Okay, the loss in fixed rate debt instrument will be compensated by a gain on the interest rate swap instrument, and therefore you will be protected. So in the exam, this question has been asked so many times. Use of interest rate swap to protect your fixed rate bond, and then they have asked you to do the hedge accounting. So you have understood forward, future, option swap. So what is the purpose of studying this as a separate unit in this chapter? Why don't we simply do the accounting as we have been doing? Whatever is the underlying instrument, follow whatever is the classification applicable to that, and derivative you follow FVTPL. What was the need to discuss it? The problem will be, suppose the underlying instrument is a debt instrument measured at FVT OCI. Suppose you have a bond which you have decided to measure at FVT OCI. Understandable? When will a debt instrument be measured at FVT OCI? When contractual cash flow test is fully satisfied and business model test 2 is satisfied. The objective is to collect the cash flow or sell the instrument also. Now to protect the value of this instrument, you use a derivative. If I do the normal accounting like we have been doing, imagine the problem now. The change in fair value of debt. Suppose there is a loss of 50 crore due to change in fair value. This will go to OCI. But at the same time, you will have a gain on derivative 50 crore. So this plus 50 crore will be shown in P&L account and this loss will be shown in OCI. So this will be causing imbalance in the P&L account. And next year what will happen? You will transfer the loss to P&L account when this derivative instrument will be derecognized. So unnecessarily 1 year profit of 50 crore, next year loss of 50 crore. Yes or no? I will recycle it next year to P&L account. So standard says this is going to cause undue volatility in the P&L account. So do one thing, either you change the accounting of FVT OCI instrument or you change the accounting of derivative. Either both should go to P&L account or both should go to OCI. That is hedge accounting. Hedge accounting idea is that avoid the unnecessary fluctuation in the profit and loss account. You can see this example. Okay. Same thing for amortized cost instrument also. So instead of amortized cost instrument, instead of FVT OCI, it was an amortized cost instrument. You don't recognize change in the fair value of an amortized cost instrument. But the change in derivative you will recognize in P&L account. So imagine the problem. Only you will recognize profit now. Next year, suppose it will be sold or realized, you will recognize a loss of 50. So 1 year profit 50, next year loss of 50. I'm going to solve the same problem also on this point. But then unnecessarily 1 year huge profit, next year huge loss. Total is 0 because the loss was fully hedged. So then what I'll do, I will move from the regular accounting of amortized cost. I will measure it at FVTPL and then the loss in this instrument and gain on derivative both will be accounted in the same year. Both will be accounted in the same year. So that is the benefit of hedge accounting. It tries to avoid the fluctuation in profit and loss account. So there is a note written there. The hedge accounting refers to recognition of changes in the value of hedged item and the financial instrument used for hedging in the same period. We try to bring both the hedged item and the hedging instrument in the same period in the P&L account or in OCI. Now, some technical words you have understood so far. Hedging you have understood. Hedged item. What is hedged item? The one whose value we are trying to protect, which can be an asset or a liability. And hedging instrument means derivative or a contract used for hedging purpose is hedging instrument. Hedging, now example of hedging. ABC Limited, an Indian company, enters into a contract to acquire a new machinery from Alabama, an American company. Is it printed in your book also? The cost of the machinery is $50,000 and payable in 1 year's time. ABC Limited functional currency is INR and the current exchange rate is $1 is equal to INR 50. ABC Limited faces the exchange risk associated with this contract. As you understood, because you are going to pay in dollar, rate of dollar can change. To eliminate this risk, ABC Limited enters into a forward contract to acquire $50,000 in 1 year's time at the current exchange rate. So you have locked the rate only using a forward contract. So now after 1 year, you will buy $50,000 by paying rupees 25 lakh for the machinery, irrespective of whether the exchange rate has moved up or down. This is an example of hedging. And other examples also I had given you. If you have got equity share and you want to sell it after some time, you want to ensure that you don't suffer the loss, but still you want to make the profit. Buy a put option. Buy a put option on that equity instrument, which will ensure you don't suffer the loss, but you'll make the profit. So hedged item can be an asset, liability, or a transaction that exposes an entity to risk of change in fair value or risk of change in future cash flow. So there are two types of risk that we have. Either the fair value can change or the future cash flow can change. Fair value means, suppose I have equity share purchased for crore rupees. Its value may become 20 lakh. That is called fair value risk. The fair value of the asset can go down. And cash flow risk means I may receive or I may pay more cash. So I have inventory which I want to sell after 1 year. So here the risk is that after 1 year, the selling price may fall and I will receive less cash. I have issued bond which carries floating rate of interest, LIBOR plus 2%. If LIBOR rate goes up, I will have to pay more interest. That is called cash flow risk, where either the outflow may go up or the inflow may come down. Is it right? And this is what we want to hedge. The management of the company will have to make a note of it, either through board resolution or the special committee resolution. Somebody who is authorized to take the decision, he has to make a note internally that we want to hedge this risk. That is, we want to hedge this risk. So hedged item can be 5 items they have mentioned in the standard. It can be a recognized asset. That is an asset appearing in financial statement. Recognized liability, a liability already there in the financial statement. Unrecognized but firm commitment. Unrecognized means it is not appearing in the financial statement right now. Like the example printed in your book, you have entered into a contract to buy machinery from Alabama after 6 months at $50,000. That is an example of unrecognized firm commitment, because that contract is not shown in books right now anywhere, but there is a commitment, a contract to buy machine at $50,000. Fourth is called highly probable forecast transaction. Highly probable means I want to sell inventory after 1 year. I am sure I am going to sell. The probability of this sale taking place is very, very high. But it's not a commitment. It's only a plan of action that we want to sell this inventory after a year. So a probable forecast transaction which is highly probable. And then some companies have investment in foreign operation. This we will not discuss today in detail because there is a separate chapter on that. IS 21, effect of changes in foreign exchange rate, which also includes a discussion of foreign operation. So net investment in foreign operation can also change in value because of the change in exchange rates. So 5 items. So once again quickly, hedged item we have understood, the one whose value we want to change, and there are 5 types of hedged item as per this standard: recognized assets, recognized liability, unrecognized firm commitment, highly probable forecast transaction, net investment in a foreign operation. And now hedging instrument. Hedging instrument is an instrument the objective of which to hedge the fair value risk or the cash flow risk of a hedged item. Is it right? To protect the risk. It is usually a derivative product, but it can be any other contract also whose objective is to protect the risk. What is the treatment of derivative? Usually derivatives are assumed to be held for trading and therefore they are accounted as FVTPL instrument. However, if the management wants to use hedge accounting, then the treatment of derivative or the hedging instrument will be as per the special hedge accounting rules. Okay, this paragraph I have explained the objective of hedge accounting. Why this special chapter or special section has been introduced in this standard, which in the actual standard runs into many pages and many paragraphs. Okay, we have only written what is required for basic understanding and exam purpose. Interested student can read the original text, bare text. The objective is matching the gain or loss on the hedged item and the hedging instrument should be recognized in the same period in P&L account or OCI. Because ultimately my net effect is either nil or close to nil. Loss on hedged item is 50 crore. Gain on derivative is 50 crore because I had used the derivative to protect this instrument. But if I recognize them in two different periods, so one year will show either high profit or high loss and the other year will show reverse. So you will say, how does it matter? Dear, it matters. It affects your share prices. Suppose in the first year you have declared lot of losses, which of course is not an actual loss because it is protected by the derivative. But that will come in the next year, the gain. By that time the damage has been done. Okay. So matching principle. Or it should not happen that one item is going in P&L account and the other is going in OCI. So again we will try to bring them in the same place. Okay. Second point is what is perfect hedge. Perfect hedge means the loss in hedged item is fully compensated by gain on derivative and vice versa also. That is called perfect hedge. Perfect hedge may not always be possible, but at least the standard says if not perfect hedge, at least the hedge should be effective. Hedge should be effective. So this standard will be applicable only if the hedge is effective. So there is no benchmark in this standard for checking the hedge effectiveness. It has left to your judgment. It has been left to your judgment. The previous version of standard on financial instrument had given a range 80%. So if the derivative at least covers 80% of your loss on your hedged item, then yes, it is effective. However, now there is no such benchmark. Okay, management should see that a significant portion of my loss is being recovered through the gain on derivative. So that is called hedge effectiveness. It is the degree to which changes in the fair value or cash flow of the hedged item that are offset by change in the fair value or cash flow of the hedging instrument. So hedging effectiveness means degree to which the loss in one is compensated by the gain in another. How do you check effectiveness? There will be change in the value of both hedged item and hedging instrument. If there is no change in fair value of hedged item, why do I need a derivative for that? Okay. But the change should be in opposite direction. Change should be in opposite direction. That means the loss in one will result into gain on the other. So the change occur both in hedged item and the hedging instrument when the change value of hedged item offset or closely offset. Offset means 100%, but 100% may not be practically possible every time. Closely offset the change in hedging instrument, then the hedged item is deemed to be highly effective. So one has to apply the judgment. If only say 10% of your risk is hedged, then that is not an effective hedge. Now for accounting purpose, in this chapter there are three types of hedges. Which are the three types of hedges here? One is called fair value hedge, cash flow hedge, and net investment in a foreign operation. Hedging of a net investment in a foreign operation. So first we'll see the meaning of fair value hedge. Very easy. Name suggests everything. The objective is to hedge. The objective is to hedge what? The fair value. Change in fair value of what? A recognized asset or a recognized liability or an unrecognized firm commitment that could affect profit or loss. Simple example, I'll repeat some examples so that it will remain for a long time. You have investment in the equity share worth 1 crore rupees and you want to protect the value of that investment because you want to go to Stanford. Okay, so you will take a put option. So that is a fair value hedge because you are interested in protecting the value of your equity share. Or you have investment in bond 200 crore. You want to sell this bond after a year and recognize 200 crore. But again, the risk is that market rate may go up, market rate of interest may go up, value of bond will come down. So you enter into an interest rate swap to protect the value. That is also fair value hedge. Okay. Next is cash flow hedge. Now, cash flow hedge, the objective is to protect the variability in cash flow. The objective is to protect the simple. You have suppose issued a LIBOR plus 2% bond. So every year as the LIBOR would change, your interest outflow will change. So you have an apprehension that the rate of interest may go up. The LIBOR will go up. Today it is 2. Next year it will become 4. So right now I am paying 4%. Next year then I will pay 6%. Then again 8%. So you want to protect this risk. Can we do that? Yes, you can use interest rate swap. You can use interest rate swap. Reverse for an investor. He may have invested in a floating rate bond, LIBOR plus 2%. Now his risk is that the rate of interest may fall and his cash inflow may decline. So therefore he can also use interest rate swap for hedging purpose. This is called cash flow hedge. Okay. Or the third example I have printed in your notes. ASF Limited is a highly probable sale of commodity in future. So when if you have to sell something in future, here also there is a cash flow risk. Selling price per unit may fall and your cash inflow will be lower. Or if you want to purchase a highly probable forecast transaction, you want to buy inventory, price may go up. So to hedge this, you can take a future or a forward contract. And then there is hedge of a net investment in a foreign operation. Foreign operation means a foreign subsidiary, foreign associate, foreign joint ventures, foreign branches. These are hedges designed to protect against the translation losses that may arise on translation of foreign currency financial statement into reporting currency. Because foreign exchange is involved and conversion is involved, there are losses, possible losses. So you take hedge against that also. Now hedge accounting is not easy. Hedge accounting requires the company to follow some conditions to qualify for hedge accounting. Okay, it's not that anybody can follow hedge accounting whenever they want. The standard says you want to follow hedge accounting, you say yes, follow these conditions. First is formal designation and documentation. That means the management will have to make a list of hedged item which they want to hedge. Management has to make a list of hedging instrument they want to use for hedging, and then they have to do the documentation of what documentation? Nature of risk being hedged. What is the risk management objective and strategy? This they have to write down, and the auditor will review this, whether the company has actually entered into a formal designation and documentation of their risk management philosophy. This is usually done at board level, but maybe done at a higher level other than board also. And then for cash flow hedges, the subject of hedge must present an exposure to variation in cash flow. Is this line written? No. Why? Just write down one more sentence. For cash flow hedges, the subject of hedge must present an exposure to variation in cash flows. Must present an exposure to variation in cash flow. So if you are using cash flow hedge, then you must demonstrate that there is a variation in cash flow risk. Subject of hedge must present an exposure to variation in cash flow. Next two lines are printed, don't write. The hedge is expected to be highly effective. The hedge is expected to be highly effective. That is, it means, the meaning I have written, change in fair value or cash flow of the hedging instrument offsets the change in fair value or cash flow of the hedged item. And then one more point I have written in your notes, hedge is assumed on an ongoing basis for its effectiveness. So hedge has to be continuously effective. Hedge has to be continuously effective. Not just for one period, it has to be continuously effective. Translation loss is a notional loss, but it affects the value of the net asset of the company. But after that period, we reverse the we will not gain or loss, but the same thing is what is this purpose of hedge accounting. It should not cause variation in the financial statement. Okay, otherwise what will happen if I don't follow hedge accounting? In 1 year you will show loss and the other year you will show profit, but actually it is nothing. Okay, so therefore when you follow the hedge accounting, that variation is eliminated. That is the purpose of hedge accounting. P&L account will not be very fluctuating if you follow hedge accounting properly. Now the first part of this chapter, hedge accounting, fair value hedge. Objective is to protect the change in fair value of asset, liability or a unrecognized firm commitment. Example where we can use fair value hedge. It is mostly used for fixed rate instrument. Because in case of fixed rate instrument like a bond, either as a liability or as an investment, if the market rate of interest goes up, the value of the bond falls. If the market rate of interest falls, the value of the bond rises. Okay, so there is a risk that the value of your asset or liability may change. In case of asset, the risk is that the value will fall. So tomorrow if I want to transfer this asset to someone, I'll get lower amount. Okay, I'll get a lower amount. And in case of liability, the value of the liability may rise. And in order to transfer this liability, I will have to pay a higher amount. If I am transferring my liability to somebody, I will have to pay a higher amount to transfer that liability. Or for example, investment in equity shares. Now I have written around 6 points. Very carefully read them and keep in mind when you solve the problem, because accounting will be now done as per these 6 points only if it is a fair value hedge. First you have to see what is the nature of hedge. Is the objective to protect fair value or variation in cash flow? If the objective is to protect the fair value hedge principles will apply. Sometimes institute can give you that follow fair value hedge accounting, then don't apply any intelligence. If the problem specifies the method of hedging. Hedging instrument is measured at fair value as usual. Nothing new. The derivative is hedging instrument will be measured at fair value, and the fair value will be recognized in P&L account. If the hedging instrument, but there is a small exception here, if the hedging instrument hedges the equity instrument, now this is something you have to understand and keep in mind while solving a question. Normally, what is the treatment of hedging instrument? Normally, P&L account. But now you see the effect of hedge accounting. If the hedging instrument is used for hedging an equity instrument, and what is the classification of equity instrument? FVTOCI. Now let me check. When can you classify an equity instrument as FVTOCI? If it is not held for trading and the management voluntarily wants to choose that designation, normally used for long-term strategic investment. Second question, where do you carry the change in fair value of an equity instrument? OCI. Now you visualize the problem. If you can visualize, then you will understand better. This is my equity instrument. Let us say equity investment in equity share. And this is a derivative I am using. Let us say future, forward, future, option, something. Normal accounting principle says, and this instrument is FVT OCI instrument. If it is FVTPL, then there is no problem. Both will go to P&L account. Then actually I don't need to apply hedge accounting also, because in any case both are recorded in P&L account. But problem will arise when equity instrument is OCI. Change in fair value will go to OCI. Change in fair value of derivative, P&L account. Effectively, if I take the total of the two, it is negligible, because if it is an effective hedging instrument and if there is a loss here, it should be gain here. And if it is effective, if there is a loss of 100, then there must be gain of around 100, 95, 98, 99, something like that. So my effectively I am not losing anything, but my P&L account will show, oh, profit 100, OCI loss, but they are same. So what I'll do, I have to do some correction now. So what correction I can do? Now some of you will suggest me that why don't you transfer this also to P&L account? But this standard says in case of equity instrument classified as OCI, any fair value gain loss will always be through OCI. Even on derecognition, it won't go to P&L account. So they're very firm on equity instrument. So this I can't change. This I can't change. So the only possibility is we'll change this. I will now transfer the fair value change in derivative, which is used for protecting an equity instrument, which is measured at FVTOCI. So we are deviating from the normal principle of this standard. Derivative change is recognized in OCI. Is it right? So they will actually impact no impact on P&L account. We have protected the P&L account through this fair value hedge accounting. And now what about the amortized cost? In case of amortized cost instrument, we don't record the change in fair value. Only when we sell it, that time gain or loss is recognized. But if it is used, if a derivative is used to hedge this amortized cost instrument, change in fair value of derivative will hit the P&L account in this year, and the gain or loss on amortized cost will hit the P&L account in the next period when I am going to sell it. So unnecessary 1 year loss, next year gain, 1 year gain, next year loss. So I have to make some adjustment there. So the standard says if the hedged item is otherwise carried at amortized cost, its carrying amount is adjusted by the hedging gain or loss. This adjustment is recognized in P&L account to offset the effect of gain or loss in the hedging instrument. The effective interest rate will also be adjusted because you are going to change the carrying amount of the instrument now. So your effective interest rate will also change. If you change the number at the beginning of every year, then every year your effective interest rate will change. But what change you have done in the accounting have you noted? You are also recognizing the fair value change of this instrument in P&L account, which otherwise you would never have done. I repeat. Okay. On that also we have a problem waiting for you in the next few minutes. You have supposed this bond because only debt instrument can be measured at amortized cost. Only equity instrument can't be amortized cost. And this is derivative. If I apply normal principle of this standard, change in fair value is not recognized. Change in fair value is recognized in P&L account. But when this instrument will be sold, then the gain or loss in P&L account will be recognized. So it may be possible that there is a gain on derivative. Next year when I will sell it, there will be a loss. So 1 year gain, next year loss. So now I am going to make a correction here. I am going to measure this also at fair value, and this fair value will be recognized in P&L account, change in fair value. So this and this will now go to profit and loss account in the same period. Okay, this is for amortized cost instrument. Now what about those debt instrument which are measured at FVT OCI? Debt instrument measured at FVT OCI. This is debt instrument FVT OCI. This is derivative. Regular provision, normal provision says change in fair value will go to OCI, P&L account, and when this debt instrument is derecognized, we transfer from OCI to P&L account. But if you are following hedge accounting, you will transfer the change in fair value to P&L account instead of OCI. Now be very careful. For equity instrument we had recorded the change in derivative to OCI, but for debt instrument we will record the change in fair value of debt instrument to P&L account, because in any case the OCI later on gets transferred to P&L account. Okay, so this is for debt instrument. Change the accounting of instrument debt instrument, not the derivative. But if it is an equity instrument, change the accounting of derivative. And point number E, if the hedged item is an equity instrument measured at FVT OCI, the fair value gain or loss of equity instrument continues to be recognized in OCI. The gain or loss on hedging instrument is recognized in OCI to achieve the offsetting. Does it seem to be a repetition? Yes, it is a repetition of point number B only. Point B and E are same. F. When an unrecognized firm commitment is designated as hedged item, like this, we have to purchase a machinery from Alabama. We have entered into a contract. So that is an unrecognized firm commitment. Is designated as hedged item, and subsequent cumulative change in the fair value of firm commitment is recognized as an asset or liability with corresponding gain or loss recognized in profit and loss account. change in the fair value of hedging instrument is also recognized in profit and loss account. Now, so what they are saying in simple terms, change in fair value of this contract will go to P&L account. Change in fair value of derivative will also go to profit and loss account. That is, in the same period, you will recognize the change in fair value of the contract also and change in the fair value of the derivative also. So the effect will be minimum. And now after 1 year you recognize the machine. Any balance in that forward contract account will be adjusted against that machinery account, like we did in one problem, steel stock account. Similarly here also, that if an entity execute the firm contract to acquire an asset or a liability, the initial carrying amount of asset or liability is adjusted to include the cumulative change in fair value of the firm commitment, and that was recognized in the balance sheet. So change in fair value of that firm commitment, an account we are going to create, change in fair value of firm commitment will be adjusted against the cost of that asset or liability whenever that asset or liability will be acquired. Now we will take a break.